Hi, my name is Monil Kapadia from Kapadia CPA Professional Corporation. We are tax and accounting firm based in Mississauga, Ontario. Today's video is to walk you through the basics of personal real estate corporation, specially focused for real estate agents. Me, along with my partner Heta Kapadia, we are running the tax and accounting practice, which is based in Mississauga. Now let us walk through the basics of PREC or Personal Real Estate Corporations. On October 1st, 2020, the legislation allowed the real estate agents to form a corporation and to conduct a business under the corporation. This was a good win for all the real estate agents who wanted to take the benefits of corporation. Now, this corporation cannot be a federal corporation, but has to be a provincial corporation. So for example, in Ontario, you need to have an Ontario corporation. Regarding the naming convention, there are no strict rules right now assigned for the naming convention, and you can use your first name, last name, or you can use your team name. An example given is Kapadia Personal Real Estate Corporation. The condition for a PREC is 100% of its voting shares need to be held by the real estate agent, who will be considered as a controlling registrar. The non-voting shares can be held by the family of the real estate agent, which includes spouse, child, or parents. Being a corporation in Ontario, the favorable tax rate of 12.2 is applicable as compared to you being taxed at a very high slab when it is a sole proprietor. So this is the basic of PREC. Now let's go and have a deeper dive into each of this benefits of PREC and compare it with the sole proprietorship. So when you have a sole proprietor, which is the current status that you are into, as a real estate agent, you file your tax returns as a self-employed or sole proprietor. You claim multiple expenses, which are business expenses, against the commission on whatever is net tax left, taxable income. You pay taxes on that. Now, again, an example of few expenses that you can claim against your real estate income. When it is a corporation, obviously, you can have more expenses to be put into the business corporation and you can take more benefits. But basically, you will have expenses such as training, home office, advertising, referrals, and salaries or travel expenses. More or less, these expenses will remain the same, whether it is a sole proprietor or incorporation. Now, when the expenses are the same, why to incorporate? Why do we want it to route it through the PREC? So let's look at the benefits for PREC. There's a few benefits that I will state for the real estate corporation, and we will go in the examples in detail to understand the computations of taxes and to see the impact of this. Income deferred, income smoothing. You can also split the income. There are benefits of holding operating company, which we'll discuss in detail. Family members can be part of the corporation. Passive investment. So anything left in the corporation, you can invest it into real estate, shares, and earn passive income. There are obviously rules regarding the passive income and tax rates. We'll talk about it. And the lifetime capital gain exemption. So what is the lifetime capital gain exemption? Which currently is $883,000. This means that if you're selling the shares of qualified CCPC, Canadian corporation, you get a capital gain exemption up to $883,000. So this means that if you have created a corporation with a goodwill and has a name and you wanted to retire or you wanted to switch your business and you wanted to sell your business, you can sell your business, your corporation, the shares of the corporation, and when you earn any capital gain, up to $883,000 is totally tax-free. Yes, you do not pay any taxes on it. So let's go and jump into the example so that we have a better clarity of what we are talking. Now, there are certain assumptions that I have made because each individual have their own circumstances and own situation which differs, and we cannot generalize any of this. So my request is to meet your accountant or lawyer and then discuss your individual situation and then decide whether you wanted to go for PREC and how you wanted to structure your corporation. Let's go ahead with the example. We have Mr. R. Mr. R is a realtor who is a single individual. He does not have any tax credits from tuitions, donations in our example. He also do not contribute to any RRSP contributions. Now, when you do these contributions, obviously the tax benefits are much higher. He lives in Ontario and has a corporation registered in Ontario. For calculation purposes, we have assumed expenses to be 30% of the income. The more the income, you will end up spending more in marketing spends to expand and grow more. So for simplicity, we have kept expenses percentage of the total income earned, and tax rates are assumed to be the current tax rates for 2019-2020. So if you see the example over here, we have 3 years, year 1, 2, and 3, in which the Mr. R earns income. Each year is a different income. So year 1, he has 285,000, year 2, 200,000, and year 3, $325,000. In total, he earned $810,000 in 3 years. Now, the reason we have taken ups and downs in the business because the business can have recession and boom, and we wanted to see the effect of different incomes. Expenses, as we have assumed, 30% of the income. Net income, so in total in 3 years, $570,000 is the net income that he has earned. On this, he pays personal taxes based on his tax rates, which is coming up to $215,000. So yes, he pays $215,000 for $567,000 of taxable income earned in the 3 years. Now let's take this example and assume that the same 3 years income, he forms up a corporation, right? And takes out all the income through the corporation. Whatever is left after the taxes and expenses, he 100% takes out dividend. This is our example 1, wherein he takes 100% dividend out of the corporation, do not leave any money into the corporation. So year 1, 2, and 3, similar income, 810. He has the similar expenses, 30%, which is $243,000 in total. The net income, $567,000. Now, each year he will pay a corporate tax, which is at a substantial lower rate in Canada, and in Ontario, along with the federal, it comes up to 12.2%. So on $567,000 total income for 3 years, he will end up paying around $70,000 in corporate tax. Whatever is left after the taxes, so say for example in year 1, the $175,000, he takes out 100% dividend and issues a dividend to himself and pays personal taxes on it. So the next tax he pays is personal taxes on the dividend income. The last column in purple, which shows the total taxes that he has paid, both corporate and personal put together. And here if we see the sum, he has paid $198,000. So if we do a comparison, he makes an income through a sole proprietor versus through a corporation and takes out income through dividend, he is saving $17,000. So as compared to $215,000 in total taxes, he is paying $199,000, a good saving of $17,000. Similar situation, the only change he did was he routed his income through corporation and took out dividend. Now, obviously, there are costs associated with this, which is your incorporation cost and tax filing cost. If you consider 3 years of cost $5,000 to $6,000, you are still better off having $11,000 savings as compared to sole proprietor. Now, when you have the corporation, there are different benefits. You can do income defer or income smoothing. And in the next examples, let's talk about that. So now Mr. R has formed a PREC, and now we are looking at income smoothing. So what is income smoothing? Income smoothing is so in our previous example, he took out 100% dividend after all the expenses and taxes. Here we are splitting that income equally into 3 years. Now, theoretically, you can do this. Practically, you do not know how much you are going to earn in year 2 and year 3. But based on your experience and based on your discussion with your accountant, a number can be derived. And here, for calculation purposes, we have considered equally splitted. Now, when it is equally splitted, you are into an optimal tax situation. And a professional accountant who has experience will help you out to calculate this optimal tax smoothing throughout the years, so that you are into an optimal tax situation. And in this case, he pays a corporate and personal tax put together of $197,000 and a whooping saving of $18,000 as compared to our base example of sole proprietor. where he has paid $215,000. So yes, he's saving $80,000 by smoothing and moving the income through corporation. Now, if we see a scenario in a normal case, do you really need $166,000 in a year to pay for your bills and mortgage? Now, mark my words, you already have paid for your corporation expenses, business taxes. You're paid for your business vehicle usage. And after that, you are left with this $165,000 to be taken out per year for the next 3 years. Now, if you do not need this money, say for example, for looking to your living styles, your mortgage bills, you need $10,000 a month. So in the next example, we have shown how to defer the income. In this case, Mr. R is taking $10,000 dividend every month or $120,000 in a year. So for 3 years, he's going to take $360,000, the remaining $137,000. So total, he had $497,000. So total $497,000 instead of taking 100%. Now he's splitting into two parts. The $360,000 in dividend, the $137,000 he keeps in the corporation because he don't need that money. So when he does that, obviously his personal taxes are reduced because of the lower dividend issued. And if we calculate the total taxes, corporate plus personal is coming to $142,000. And comparing to our base example of sole proprietor, he is saving $74,000. So that's an amazing tax deferral. Again, I will correct my word. It's not tax saving, it's tax deferral, because when you route the income through corporation and when you defer the income withdrawal, you are deferring the taxes, but at some point in time, you will end up paying these taxes. But for now, you have this money in hand to be reinvested into the business, into the marketing spends for expansion. So you have this corpus left so that you can grow and make more money. In the last example, we have taken a little bit of extreme where you have enough savings in your bank account or your spouse is making enough to pay for your mortgage and bills and you do not need any dividend to be taken out from your corporation. In that case, you will keep all the money into the corporation. So now in this example, the whole $497,000 of retainer of the profit, you will keep it as a retained earning, will not take it as dividend. And that's why you do not pay any personal taxes. Now, the total taxes, both corporate and personal, will ideally be the $70,000 that you pay for corporate taxes. And when we compare this to our base example, you are saving $146,000 as compared to sole proprietor of $215,000. So yes, it's a bigger dollar that you are deferring for the future years to be utilized and reinvested. Now we saw how we can keep the money in the corporation, keep the money and defer the taxes. What are you going to do with this money? So let's talk in the next slide. Now here, if you see the after taxes cash in hand, the sole proprietor is left with $351,000 for 3 years. Now this is 3 years income minus expenses minus his personal taxes. Is left with $351,000 to be used for paying his mortgage bills for 3 years, and anything left he can do it as an investment. But in case if he has routed through PREC, through the corporation, now in the example where we saw the first two examples where he took out 100% dividend, he's left with 368, or if we smoothen out in 3 years, he's left with $370,000. Still not a bigger or significant difference, but let's talk where he deferred the income and just took out $120,000 in dividend. In our third example, so in this example, he's left with a good $425,000 as cash in his corporation to be reinvested for future years. And in the extreme case where he did not take any dividend, he's left with $500,000 in the corporation. Now, this money he can invest, reinvest into his business, use it for marketing spends, can start up another business, or there are different ways of what he can do to earn passive income. Now, obviously, there are rules about passive income. When you earn passive income, after $50,000 of passive income in one taxable year, your small business deduction limit decreases and you will jump your 12.2% corporate tax rate will jump to 26.5%. But again, You need to talk to your accountant to see your situation. There are ways to work it out, the passive income, and we can always help you decide how much you can invest and how to invest. Now, when you're left with this money, how are you going to invest this money? So there are multiple ways in the sole proprietor or in the 100% dividend that we saw, or even in the smoothing effect. In these three examples, you are taking out all the money from the corporation and then you are investing it personally. But here you are paying a lot of personal taxes and you're left with lesser amount to be reinvested. In case if you differ, you are left with 425 to $500,000, which is much bigger an amount to be invested. Now, this amount can be invested. So in your PREC, being your operating company, you can invest into shares. You can invest into other real estate properties. And there are no restrictions right now. You can do all of those under PREC. Or there is another setup of a concept called holdco, opco, the holding company, operating company. You can create one more layer of holding company and you can route your passive investment through the holding company. Let's see how does it work. So the voting shares here of the holding company are held by registrant, 100% voting shares by registrant. The non-voting can be held by family, similar like PREC. The holding company in turn will hold 100% shares of your operating company, which is PREC. In this case, the PREC is earning commission income after expenses, after taxes, whatever is left, issues a dividend to holding company, which is a tax-free dividend. Yes, you heard me correct. You do not pay any taxes when you issue dividend to a holding company. In case if you issue a dividend from PREC to yourself, you pay personal taxes, but when it goes to the holding company, it is a tax-free transfer. Now, what does the holding company do? It can invest on its own, or it can create subsidiary 1 or subsidiary 2 and give loan to the subsidiaries to open up another business or to invest into real estate shares. So there can be multiple things that can be done. Now, this structure is little complex. So I would request or recommend to talk to your accountant or lawyer to understand how does it fit into your scenario and to optimize the situation. Next steps. So obviously, first of all, you need to decide whether you wanted to continue as a sole proprietor or do through a corporation. Now, there's no generic rule about it. The situation differs, and the way we wanted to take this is, if you are a startup, you are a new real estate agent, not making too much money. Say, for example, somewhere below 100,000, and you need all the money for your paying off your personal liabilities, then you should continue as a sole proprietor because it does not make any sense from the tax viewpoint to corporate. The tax admin fees and everything is more as compared to the benefits. But if you're looking, if you do not want that money and wanted to keep that money in the corporation, or if you are earning good enough money more than your basic needs, then corporation is the way to go. Talk to your accountant or lawyer about the corporation structure, whether you wanted to have an operating company or operating and holding company, and how you wanted to structure it. The question is, can you do it yourself? Yes, of course you can do it yourself if you understand the articles, if you understand how to customize those, and you understand the corporate structure, you can do it yourself. But I would recommend to take an expert service because this is done for once. Any change in the structure is very time consuming and will become an expensive affair for you. Bookkeeping will be a basic way, or you can use QuickBooks account. You have to set up a payroll. The income that is left in the corporation after taxes can be taken out as salary or can be taken out as dividend based on your individual situation. You can talk to your accountant to see what fits you. And obviously the tax consulting and tax filing, you need to touch base with your accountant to work to see how what is best scenario for you or optimal scenario for you. Just a brief about our services. We do personal filing and corporate filing. We do incorporation, both provincial and federal. If you're a startup, we will help you set up the books and initial consultation, payroll setup, and all of those stuff. If you, from your holding company, if you're planning to do a different business, then we can always help you out to even to get a business loan from the banks, or we can deal with the CRA audits. The team, so it's me and my spouse, our partner, Monil Kapadia, who is equally qualified. We have Ayushi, who is CA from India and is a senior accountant. We have bookkeepers, Shreyal and Prashant. So this is our team. We help you set up all the bookkeeping requirements, set up the corporation, the initial minutes, initial chart of accounts, and we can walk you through the basics so that you are very comfortable and you do the things very correctly. If you have any question answers, my contact information is available on all the slides. You can contact me, email me, or call me. We are taking appointments for the real estate agents because this month we wanted to set it up all in a correct way so that you can proceed and work out the most optimal way. Uh, and thank you so much for being patient. Feel free to call me or discuss with me if you have any questions, and we can take this from that. Thank you so much for that, for attending the webinar.